As promised last week, we stick with Asian markets in today's episode, and we're delighted to be joined for what is always a well-considered and insightful discussion with Tom Naughton. Following the People's Bank of China's noteworthy easing announcements at the end of September, the anticipated press conference held by the country's Ministry of Finance over the weekend perhaps disappointed many investors searching for that exact detail on the quantum of upcoming fiscal stimulus packages. However, whilst the probability of success of these support measures is still highly uncertain, the change in policy trajectory is still noteworthy. And despite the upcoming UK budget and of course the US election likely to quite rightly capture much of the headlines over the next month, and probably well beyond, we continue to believe that Asian markets warrant close attention at the current time, particularly against this backdrop of high concentration and wide valuation dispersion, which remains a feature of global markets. And so we discuss the region again with another experienced regional specialist from the boutique Prusik Investment Management. Welcome to the Investor Insights podcast, hosted by Killik Co. My name is Gordon Smith, and in each episode, I'll be interviewing portfolio managers from across the investment industry to gain from their expertise in the specialist areas in which they invest, and to question them on topical issues. You can access the full series of interviews via the playlist on the Killik Co YouTube channel, or by searching for Killik Co's Investor Insights on Spotify, where you can subscribe and be notified of future episodes. We hope you're enjoying the discussion so far, and you can get in contact with us about any of the topics discussed via the email address investorinsights@killik.com. Killik Co is an independently owned wealth manager which opened its first office in 1989 and provides services to help families save, plan and invest. And you can find more details on the unique ways in which we do that at our website killik.com. In this episode, we were joined by Tom Naughton, Chief Investment Officer and Managing Partner of Prusik Investment Management, the independently owned boutique fund management company which was founded in 2005 and specialises in Asian equities. Tom joined the company in 2010 to launch what is now the company's single Asian ex-Japan equity income strategy, but he started his investment career in the mid-1990s, and his nearly 30 years of experience in Asian markets has included very successfully running a hedge fund in Hong Kong before continuing that success with the long-only strategy at Prusik. The Asian Equity Income Fund aims to invest in companies with an attractive starting yield and which are able to sustainably grow that dividend in real terms and where there is valuation upside. I hope Tom's distinctive approach to investing in Asian markets, his search for convexity and optionality in prospective holdings for the fund, and the absolute, not relative mindset he has comes across in this conversation. But please do get in touch if you'd like to discuss any of the topics mentioned in this episode. We're always keen to hear your feedback or suggestions for future episode topics. Tom, good afternoon. Thank you so much for sparing some time today. How are you doing?
I'm very well, Gordon. Thanks for having me on.
Not at all. Yeah, thank you for joining us. So we've got this kind of standard opening question, which kind of attempts to get a bit of an insight into kind of you and how you go about your work. I wondered if there was a kind of research project you could talk us through, or an anecdote from a recent meeting, or even just a kind of article or book that you could share.
Yeah, I mean, one thing I was just reading a week or so ago was a very good article in a publication called The Wire, which is it's an English language publication about China, which is absolutely brilliant. And there was an article by Tim Clissold, who was an English chap, but he was an investor in China in the 1990s, and wrote a very good book called Mr. China about that. But he wrote a very interesting article about China, and I think it's worth reading, because most articles in China tend to be either extremely optimistic or extremely bearish, and there's very few sort of balanced articles, and this one was quite balanced. But what I thought was interesting in it is he said, regardless of what you think is going on in China, we want to understand it. We should be understanding it. And in the UK, he has a stat that there's essentially less than 300 people in the UK studying anything with Chinese language in it at university, and saying if it's really this big epoch-defining challenge and it's going to be the most important change of this century, we should really have more people who understand China. And I think it really is, very telling, because I think, certainly, the understanding level of China is extremely low, and that causes lots of problems. And, as I say, whether you're pessimistic or optimistic about China, I think it would be a good idea if we had more people in the UK and the US who understood the country and the culture to help us navigate the world over the next several years and decades.
Yeah, no, very interesting. 300 does sound like an awfully small number of people. So yeah, I'll dig out that article. Yeah, thank you for that. So Tom, I thought what we do just for kind of a first proper question. You've got such a kind of distinctive style to your kind of approach to investment. I wondered if you could kind of just maybe summarize kind of how you go about things, just to kind of frame the discussion, frame the rest of the conversation.
Yeah, absolutely. But I think there's been this interesting, almost parallel shift in investing style over the last 10, 20 years. And so most people who were quality managers 20 years ago have now morphed into growth managers, I would argue, because a lot of those very high quality companies like Microsoft or MasterCard or TSMC that used to trade on 10, 15 times earnings have now re-rated up to, 20, 30, 40 times earnings. And so really are, really priced fully loaded for growth. And then I think anything outside those sort of narrow group of, you can call them sort of compounders or quality compounders, has really been derated dramatically. And so even though I feel myself, I'm a quality manager, I haven't changed. I think that, most people regard me now as more of a value manager, because I think a lot of those companies that fall outside that group are trading at incredibly low valuations. So I think my style is, I would think of myself as a blend between quality and value, but being value is as important, and you can't look at one of them without the other. And so it's a sliding scale of quality and value, and you're really looking to buy companies which are high quality but underpriced. And I suppose the way I would look at it is, we're not trying to buy AAA rated companies and pay high prices. We're looking for companies that are single A or double A or triple B rated, but are priced at almost distressed levels. And that's our target area of the market. And I suppose that's my DNA is that I don't know what's going to happen in the world, and I certainly don't know what's going to happen in Asia. And so I want to buy stocks that if I'm wrong, I don't lose too much money. But if I'm right, we're going to make a lot of money. And I think having that sort of optionality exposure is really the way I approach investing, because, and I say it's born out of the fact of I don't know what's going to happen in the future, and so we don't really like paying high multiples for anything. So that's, I suppose, in a nutshell, my approach.
Yeah, no, that summarizes things well. Yeah, I think that the tagline of valuation being as important as quality from some of your recent presentations is certainly a kind of takeaway for sure. So I think we've spoken to kind of a variety of managers on this series, and one kind of common thread has been this kind of dispersion in returns and valuations and the kind of concentration in markets, and it's kind of no different in Asian markets. So I thought it might be useful to kind of run through some of those kind of major areas that you are exposed to in this portfolio, but also those kind of key areas that you're kind of largely avoiding within the strategy. I wondered if we could kind of start with India as being a kind of an area which, given that what you've just said in terms of kind of crowded trades and more richly valued areas, can you kind of summarize your thoughts on the Indian market at the moment?
Yeah, no, absolutely. And I think it's something, you made a good point there. And I think certainly the way we're positioned at the moment is very unusual, because I think it is much more about what we don't own as opposed to what we do own. And that's very unusual for us. And I think this divergence between, popular and unpopular, or cheap and expensive, is the highest it's been for 25 years. It's really just off the charts in terms of how highly some things are valued and how cheaply other things are valued. And in my view, in Asia, a lot of what's going to determine returns over the next 5 years is going to be avoiding very expensive things as opposed to doing anything else. So I think if you look at the set of Asia X the expensive things, I think it all looks pretty reasonable. In other words, we could talk about the different markets, but outside the expensive markets, which in my view are, India, Australia and Taiwan, I think everything else outside that looks pretty cheap. But India, as you say, is a market where it is off the charts expensive. And a lot of people say, well, it's always been expensive, but that's not true. I mean, it's just, you can look at any valuation measures to see it's extraordinarily expensive compared to its own history, let alone in absolute terms. And the way I think about doing everything is, the way we look at stocks and markets is to forecast returns by looking at the yield, what we think that yield's going to grow at, and what we think the change in valuation is going to be. And that's just how returns are always decomposed. And even though India, I think, will have reasonably good earnings growth over the next 10 years, you've got three issues which are going to really drag on that. And they are, firstly, the fact that you get currency depreciation, which people often ignore in India, that you've historically had about 3% currency depreciation versus the dollar every year. The second is capital gains tax, which India is unique really in Asia, that it charges a capital gains tax. So that is between 12.5% and 20%, which produces a reasonably significant drag on returns over time. And then finally is that valuation, which when you're paying 25 times earnings for a market, or it could be 30, 40, 50 times earnings, but most likely it's going to be at 15 to 20 times in 5 or 10 years' time. And therefore the drag you get from that, I think, is very likely to offset a lot of the positives you get from earnings growth. And on top of that, India is an emerging market. So even though I'm very optimistic about India over the next 10, 20 years, it's not going to be a straight line between here and there. Lots of things can go wrong. And I think emerging markets, coming back to the point I made earlier, you always need to be conscious that things can go wrong. And, we don't know what that's going to be. It could be Modi not getting elected. It could be something happening in the economy or in inflation. There's lots of things that can happen which can cause problems for the stock market. And when you're not receiving much risk premium, your downside in those cases can be very significant. As we saw in China over the last 10, 15 years, China used to be very highly rated. People were very positive on it, and now it's at the opposite end of that spectrum. So that's my view in terms of India at the moment.
Yeah, no, thank you for that. Yeah, that kind of higher valuations always kind of increase the risk if things do go kind of wrong, even if it is kind of temporarily. Maybe let's move on to kind of an area where the portfolio does have kind of notable exposure, and you've referenced kind of China and kind of Hong Kong markets kind of grouped in with that, but I mean, there obviously still are these challenges. I mean, I probably don't have to kind of reel off a list of kind of challenges that China faces at the moment, but in terms of kind of the property sector and trade tensions. But I just wondered kind of how you balance the clear kind of valuation opportunity with those challenges that the markets still face. And if I can bolt on a kind of second part of the question, that kind of recent stimulus measure that the kind of policymakers in China have kind of initiated, I'll be fascinated to kind of hear your kind of take on that. Even though it's kind of such a short-term thing, it has had such a big market impact. So.
Yeah, I agree. I mean, China is fascinating. It's incredibly complicated. But I think if we were making broad brush statements that, yes, there are lots of problems in China, but there's also lots of good things in China as well, in terms of the strength they have in certain industries, electric vehicles, many high-end areas of manufacturing, generating millions of STEM graduates every year. There's lots of things they're doing in the long term that could be quite helpful for growth. Plus they have, world-class infrastructure, a fairly stable, in many ways the social structure is relatively stable. So there's lots of the positive things. And it's almost the opposite to India. Like, India's got lots of negative things about it in terms of, corruption, the difficulty of putting in infrastructure, the way that states operate, the difficulty in building manufacturing, the lack of female participation in the workforce, lots and lots of these things. But during a bull market, no one cares, correctly, because when economic growth is improving, when money is flowing into markets, who cares about it? Doesn't make sense. I don't mean that in a cynical sense. It just genuinely doesn't make sense to worry about downside risk. But it doesn't mean it's not there. And in China, it's the opposite. Whilst you have these very significant short-term problems, it doesn't make sense to look at the long-term positives, because they're not going to determine what happens to the market over the next 12 months. So I think the way I think about China at the moment and think about the problems are, the most significant problems they have are this sort of debt deflationary, too much debt, deflation, a property sector which is still very, very weak and very low consumer confidence. There's other problems like the demographic growth challenges, but to me, that's not, that's something that, yes, that is important over a 10, 20 year view. And yes, it is important when you're paying very high multiples, but when things are very cheap, I don't think it's something that we need to worry about from the stock market point of view. I think the positives about the recent government announcements and interventions in the market is they have shifted the view, or they've made it clear that the government is moved away from this idea of not caring about it or letting the local governments sort out the real estate market to now a stance where it's not quite whatever it takes, but it's pretty close to that they're now showing a lot of willingness to put in place the amounts of money that are required to solve this problem. And the way I've always thought about it is the real estate problem, you can look at this as it's almost the same as the non-performing loan problem or the bad debt problem, is something like a low single-digit trillion US dollar problem. So it's, this is a significant problem that will cost 10, 20, 30 trillion RMB to fix. But it's something that China can do. And once you have solved that, if you're able to solve that and deal with the real estate issue, then I think that solves a lot of other problems with regards to consumer confidence and then moving on. And I think we're getting close to that point now. So my view is we're probably half the way through this downturn in the China real estate market. We're not at the end of it yet, but we're getting further along. And as we remember from 2008, 2009, we don't need to get to 100% of this finished before the markets will rebound and confidence will improve. We need to get something like 60, 70, 80, 90%. It's not clear exactly where, but we need to get far enough along that people can see the end of this process. And then when we get there, the markets are normally quite quick to respond. And then obviously that has a knock-on effect to confidence and consumer spending and so on and so forth. So I think, to me, the way to think about China, investing in China, is not really to think, will they be successful, will they not be successful? Because obviously there's a bullish case in which what they do works and the economy recovers and so on, and there's a bearish case in which it's pushing on a string and nothing happens and things get worse. And my view is to say, well, where can we buy stocks where we've got good participation to the upside if China does recover and stabilizes, but we've got good downside protection if it doesn't? And thinking about that trade-off in a much more sort of clear and sort of mathematical way, to me, that's what we still should be doing, because I don't think it's possible to say which of those will happen. If you're too pessimistic, to me, then you're potentially giving up a lot of potential opportunity. If you just say, I'm not touching China at any price, it's uninvestable, you're giving up what is possibly, if India is the most exciting long-term market in the world, China is probably the cheapest and biggest value opportunity in the world. And I think if you don't, if you're giving up looking at that, you are giving up a lot of potential upside. But I don't think, at this stage, it makes sense to say, yes, it will definitely be successful, or, no, it won't be successful.
Yeah, no, some really important points in there. Thank you for that. Tommy, you very kindly gave us a kind of presentation to us not that long ago, and one of the kind of other kind of noteworthy allocations within the portfolio is to some of the kind of ASEAN regions and a lot of the kind of consumer stocks in places like Indonesia, Thailand, Vietnam. I wondered if could you kind of give us some of the examples of the kind of opportunities you're seeing in those markets?
Yeah, I mean, as you say, we really like these Southeast Asian markets. And what's interesting is if you look back over the last 10 or 20 years, these markets with India used to trade at very similar valuations. So Indonesia, Philippines, India, all traded at very similar valuations, even 5 years ago. But if you go out 10, 15 years. But over the last few years, there's been this big divergence. And we can go into the reasons why that is. But essentially, they've got very similar dynamics, these markets. They've got very young populations. median age less than 30, very low household debt to GDP, so, growing middle class. So you have this opportunity which is what people are looking for in emerging markets, which is growth in many different sectors of the economy as this middle class grows and more people are brought into the formal economy. And I think Indonesia and the Philippines in particular had a very tough time over the last few years, partly because they were hit very hard by COVID, very little support for people, but big, very strict lockdowns. And then, after that finished, we had the big rise in energy and food prices, which really hit these markets. And then most recently, as the Fed has raised rates, Indonesia and the Philippines have very hawkish central banks that were very aggressive, hiking rates to defend the currency. And so even though the macro looks fine there, I don't think they needed to be that cautious. It's just the history of the last 30 years means they do operate in a very conservative way. So you've had really 5 years of quite tough economic conditions. But going forward, I think these markets can grow at 5-6% and can have, consumption growth and revenue growth higher than that. So, we really like consumer companies across the board. So we like things like Indo Food in Indonesia, which is the world's largest noodle company, very high returns, very strong brand position with 70% of the noodle market. We like stocks like Thai Beverage, which is exposed both to Thailand and also Vietnam in beer and spirits. So those would be two of the companies we really like in those markets. But even the banks in many cases are sort of consumer facing. So things like Bank Rakyat, BPI, Bank of the Philippine Islands in the Philippines. One of the big sort of trends there is this growing consumer lending. Now, because consumer debt to GDP is very low, you can see loan growth, continuing to grow at a multiple of nominal GDP growth for the next 10 or 20 years. Yet valuations are very, very depressed. So I guess those are some of the names, and the reason we like it is good growth, very cheap valuations. I've had a tough few years, but we think the next 5 to 10 years looks very good there.
Yeah, no, thank you for that. Tom, I appreciate a lot of what kind of your time is spent on kind of stock specific issues. Yeah, I think you made that very clear in the kind of looking for those asymmetrical returns in kind of China and Hong Kong, but you've often got a lot of kind of insightful comments on the kind of macro picture, and given that markets are still, probably the Chinese stimulus was triggered by that first rate cut in the US, certainly kind of helped things along. I wonder if there's anything you can kind of sum up the macro picture in relation to your kind of outlook for the Asia region at the moment.
Yeah, I think it's quite interesting. I think, let's say with the backdrop that we think maybe we're in a rate cutting cycle in the US, and we're seeing the dollar maybe not weakening, but not strengthening anymore. With that sort of backdrop, I think Southeast Asia, and Hong Kong look very good from that perspective. That's just a very, very good backdrop. The thing that we've been missing up until a month ago, or a few weeks ago, was the stability in China, Hong Kong. I think if we get that stability, and this is not talking about a big recovery in the economy, but just a belief that we are close to the bottom in growth expectations. We're not there yet, but if we do, then I think that's really the final thing that puts into place for a very strong position, a very strong performance of Asia, ex the expensive markets, if you see what I mean. Because Hong Kong and China are obviously sensitive to both falling rates and a weaker dollar, but also they require a stability in the economy. Southeast Asia doesn't really need the stability in China. That's not that important. So they will do very well and have been doing well just with the first part of that, the weaker dollar. So I think, to me, Asia looks pretty good at the moment, and it would look extremely good if we see this stability in China. In my sense, if you ask me to bet, I'd say it's a sort of 2/3, 1/3. If I said, will we see, will these measures have the impact of stabilizing? I'd say there's a 2/3 chance they will and a 1/3 chance that they won't. And so given where valuations are, the upside is I think, very, very appealing from those markets and that area.
Yeah, great. Thank you for that. Tom, we've kind of rattled through quite a lot of areas over the last 20 minutes or so, but our kind of standard final question is one that asks the speaker where their kind of highest conviction area is at the moment. I wondered if there was kind of one particular kind of area of the portfolio that you'd highlight there.
I think if you ask me, I would say Indonesia and the Philippines, and probably the Philippines is probably the highest conviction area. The only thing that constrains us having more money there is liquidity, is these markets are so small. Even for a fund like ours, we're only, $800 million. It's a challenge to get money into these markets. And so we're constrained by liquidity and how much we can have there. So I think those are the best because you don't really need anything to happen. They're fine as they are. I think when you look at Hong Kong, that is probably slightly more upside potential than the Philippines, but you do have a more unpredictable part of that equation, which is China. And obviously there's some signs that China's stabilizing, but it's obviously still in a very, in a very weak position and, in a very critical position. And so I think for people that the more contrarian you are, Hong Kong is the more appealing market because it's done so badly. It's so out of favor. There's so much upside. It's much more scalable. You can put a lot more money into Hong Kong. But I'd say Philippines and Indonesia are probably higher conviction because I think the risk return in those is a lot more straightforward. And so that would be probably the pick I'd make.
Yeah, no, very interesting. Yeah. Tom, thank you so much. It's always really interesting to chat to you. Thanks so much for your time.
No problem.
Thank you for listening to the Investor Insights podcast, hosted by Killik Co. You can get in contact using our podcast email address, investorinsights@killik.com, for more information on any of the topics discussed, or for further details on the services offered by Killik Co. This podcast is not personal advice. The content is intended for educational purposes only and is not investment research or a recommendation to buy or sell any financial instrument or product, or to adopt any investment strategy. The value of your investments can rise as well as fall, and you could get back less than you invested. Past performance is not a guide to future performance. The investments referred to in this podcast may not be suitable for all investors, and you should seek advice from a qualified investment advisor. Killik Co is authorised and regulated by the Financial Conduct Authority, the FCA.